Hey guys, Marc Ventura here. I hope you're well. In this next video, I'm going to talk to you about what is LMI. So LMI, if you're not sure what LMI is, LMI stands for Lenders Mortgage Insurance. Now, there's a lot of people ask, well, what is Lenders Mortgage Insurance? So I really wanted to touch on, what is Lenders Mortgage Insurance and why is it a good thing? There's probably two schools of thought out there at the moment. There is the school of thought that it's the worst thing in the world. Like, why would you want to pay lenders mortgage insurance? It's just some fee that you pay the bank that's a waste of money. And then there's this other school of thought that the lender's mortgage insurance is actually there to help you get started in the market with the smallest deposit possible. And it can be a really good thing. I tend to fall in that camp of where it can help you to get started with the smallest deposit possible. And I'm not taking a negative view. Now I'm going to show you what LMI is, or what lender's mortgage insurance is, and why it's not a bad thing, why you should be actually happy to pay for it. It's crazy that might sound. I want to show you why you want to pay for it. And it also follows on from some of my prior videos around touching on the equity triangle, or should I buy now, or should I wait. So what I'm going to share my screen, and I'm going to draw on my screen. I'm going to show you what mortgage insurance is. I'm going to give you a bit of an example of a person that recently downloaded one of my booklets on Facebook, and the conversation I had with that person and how that was a big eye opener for him. So what I'm going to do now is I'm going to share my screen. I'm going to touch on, we're going to scribble on what is LMI. So LMI, what is LMI? So LMI stands for Lenders Mortgage Insurance. A lender's mortgage insurance isn't like a life insurance or to protect you if something happens to you for your mortgage. Lender's mortgage insurance is a fee that's payable when you have less than a 20% deposit. So when your deposit is less than 20%, so less than 20%, you need to pay this fee called lender's mortgage insurance. Now, lender's mortgage insurance is in place for two reasons. The first reason, it's there to protect the bank. So what the bank says is, if someone has less than a 20% deposit and they default on their loan, then if the bank generally will want to sell that property reasonably quickly to recoup their money. And what they know is, if they have to sell a property reasonably quickly, they might make a loss in that property because the customer doesn't have a 20% deposit. They might have to sell that property reasonably quickly. They might only sell it for 90% of its value. Now, if you didn't have a 10% deposit or 20% deposit, the bank could lose money. So the lender's mortgage insurance is there to protect the bank if we default. Okay. So it's there. The first purpose the bank's created this, or it's come into place, is to protect the bank if we borrowers default. But on the flip side, the other benefit is to us as borrowers. There's a massive benefit to us as borrowers, because traditionally, if you don't have a 20% deposit, or you didn't have a 20% deposit in the past, you couldn't buy a property. So as we know, with property prices going up so much, that 20% deposit, it's not like the old days when maybe our parents were buying property prices were a fraction of the cost they are today. The 20% deposit today is massive. So the benefit to us is that we can get started with as little as like a 3% deposit plus the associated costs. We can get started with a little deposit or a 5% deposit. And with the help of mortgage insurance, that can get us into the market really, really quickly. Now, you can either, let's say property price is 500,000. You can wait until, say, 20%, which is 100,000. And by the time it takes you to say 100,000, price is going to be a lot more. Or let's say it's 500,000 times 5% deposit. You could get in with as little as 25,000 and get in straight away and locking your price, locking your payments, locking your loan amount. And even if prices go up in the future, you're going to get access to that growth. So when you look at it, you can say, I'm going to save more to avoid LMI or reduce LMI, or I can get in the market as quickly as possible. So it's 25,000 plus the cost. associated costs. So what are some of the associated costs? Things like the actual lender's mortgage insurance or some of the government fees and charges. So that 25 grand will actually be a little bit higher. On 500,000, once you add in the costs, you're looking at around $40,000. But it's much easier to get to 40 than it is to get to 100,000. So in my opinion, LMI is a good thing. It helps you get started as fast as possible. Now, what I want to take you through is client I spoke to, today's the 13th of September. It's Monday, the 13th of September. On the weekend, on Saturday, a couple of days gone past, I had a conversation with one of my clients, well, not a client at the moment, but most likely will be. He downloaded one of my reports and booked in for an appointment in my diary. Now, this particular person, he was like, I love what you had in your report. I really want you to help me with my mortgage, but I want to wait. I've currently got about 35,000 in savings, but I want to wait till I get to 10% deposit. So I want to get up. So his price range is around 600. I go, I want to wait till I get to $60,000. Then I want to buy. I was like, okay, that's cool. Tell me why you want to do that. He's like, oh, well, I don't want to pay mortgage insurance, or I want to at least reduce the mortgage insurance. I've got friends that have bought, people around me keep telling me that, paying mortgage insurance is a waste of money, and it's, I should keep saving until I get it. So what I said to him is, I said, let's have a look at a bit of an example. Let's play a little bit of not a game, but let's look to a scenario around how that's going to play out for you. And I really wanted to show him why waiting was not going to be in his best interest at the end of the day. So what we do, I'm going to switch screens. So what we had was at 600,000, he wanted a 10% deposit. So that was 60,000 plus some of the associated costs. So say mortgage insurance. Now at this price range, mortgage insurance is probably going to be about 12 grand plus the government fees. Let's say there's another 3 grand in government fees. All of a sudden, that was going to get him, he needed a deposit of 75 grand. I said to him, how long is it going to take you to go from 35 to 75? He goes, oh, we'll save about $2,000 a month. Okay, well, 2,000 a month times 12 months at 24 grand. We're still a lot more to save. By the time you get the savings you need, it's probably at least 18 months away, maybe longer. It's almost 40 grand gap, so it's almost 2 years. I said, so instead of paying, let's say at this price range, mortgage insurance, I need to be closer to 20 grand. So instead of paying 20 grand, so to save 8,000, because that's the difference. To save 8 grand, to save $8,000 in lender's mortgage insurance, you're going to keep renting for 2 more years. At say he's paying $1,400 a month, so it's about 18 grand a year. So you're going to rent for another 2 years. You're going to pay $36,000 more in rent, and prices are going up. So on average, prices go up by 7% a year. So that price is going from 14% growth over 2 years. And it's not always that, but for this situation, let's say it's only 10% over 2 years. So we're going to go from 600 to 660. So you're going to pay 60 grand more. You're going to pay $36,000 in extra rent. So that's like over 100,000 to save 8,000 in mortgage insurance. Like that's crazy, guys, right? So this gets back to, it's better to get started with the smallest deposit possible, pay the mortgage insurance. It's not the worst thing in the world, because when you add up the rent that you might pay, the length of time, the property price increase, when you add it up, you're going to go from 600 to 660. So 60,000 increase in price, and you got 2 years of rent at $1,400 a month. Let's say 18,000 a year times 2 years. It's another $36,000 of rent. That's $96,000 you're going to pay extra to save 8 grand. It doesn't make sense, right? So I hope you get a lot out of this video. Lender's mortgage insurance is purely there to protect the bank before you get off default on a mortgage, but it's there to help us as borrowers to get in the market as quickly as possible, so that you can get away with the smallest deposit and participate in the future growth of the market as soon as you can from that side of things. So hope this helps. Any questions, please reach out and let me know. We'd love to help you with any questions that you've got. Cheers, guys.